Welcome back to Wealth Wives, the podcast where clarity meets strategy. We live in an age of information overload. Every single day, our phones buzz with breaking news. Inflation is up, a trade deal is on, a deal is off. A new technology is set to change the world. It's a constant stream of chaos. And for anyone trying to build a secure financial future, it can feel less like an opportunity and more like a threat. That's why today we're diving deep into one of the most pressing topics for our generation, investing through chaos, how to turn scary headlines into smart money moves. Our guide for this conversation is a man who has built his career on being a voice of reason in a world of financial noise. He's Max Wise, a financial strategist and educator who is a master at decoding the complex economic headlines that leave most of us feeling overwhelmed. Max, it's a real pleasure to have you back on the show.
It's great to be here, Sarah. Thanks for having me.
By the end of this episode, our goal is to give you 3 invaluable takeaways. First, we'll uncover why headlines about trade wars and market volatility have such a powerful, almost hypnotic effect on our decision-making. Second, you'll learn a practical framework to distinguish between critical signal, the information that actually matters, and the distracting financial noise that just causes panic. And finally, and most importantly, you'll walk away with a durable, long-term strategy to build your wealth with confidence no matter what the news cycle throws at you. So, Max, let's dive right in. There seems to be a fundamental paradox at play right now. Just this week, we saw the market hit a new record high on the news of a trade deal with China. On the surface, it was a moment of collective relief, a burst of optimism. And yet, when I talk to friends, to our listeners, there's still this deep, persistent undercurrent of anxiety. It's as if the good news doesn't feel entirely real, or that the other shoe is about to drop. Why is this topic, navigating financial news, so profoundly misunderstood?
Sarah, you've just put your finger on the single biggest challenge for the modern investor. It's a phenomenon I call the reactivity trap. We are culturally conditioned to believe that smart, engaged people react. We think that taking swift action is a sign of being in control. So when a headline breaks, trade deal signed, our first instinct, our trained instinct, is to ask, okay, what should I do right now? The most common and dangerous misconception is that you have to do something about every piece of news. Deal side, I have to buy. Negotiations collapse, I have to sell everything. This isn't a strategy. It's financial whiplash. And it's a guaranteed way to underperform over the long run because you're constantly buying on hype and selling on fear. Let's ground this in a real-world example, using the very trade tariffs you mentioned. Before all this tariff talk, a few years ago, the baseline U.S. tariff on many Chinese goods was around 3%. During the peak of the trade war, that figure skyrocketed to a staggering 145% on certain products. Now, after this new deal, we're looking at a new baseline of around 30%. Think about that journey for a moment. 3% to 145% to 30%. For an investor trying to time these political shifts, it's an impossible game. It's an emotional roller coaster designed by policymakers, and it has almost nothing to do with the fundamental value of the great companies you might be invested in. The anxiety you're describing comes from people trying to ride that roller coaster, and inevitably they get sick.
That's a powerful way to frame it. The idea that we're reacting to policy whiplash, not business fundamentals.
Exactly. Let me give you a quick case study. Imagine 2 investors at the start of all this tariff talk a few years ago. Investor A, let's call her Alex, is glued to the news. She has alerts on her phone, she buys an index fund when a positive tweet comes out, and sells a portion when a negative headline breaks. She feels active, she feels engaged, like she's playing the game. Then you have investor B, we'll call him Ben. Ben understands the reactivity trap. At the start of the year, he created a simple plan: invest a fixed amount of money every single month into a diversified, low-cost portfolio. Rain or shine, good news or bad news, his only action is to stick to his automated plan. Fast forward to today, Alex is emotionally exhausted. She's probably bought high and sold low a few times, chipping away at her own returns. She's stressed. Ben, on the other hand, is calm. His portfolio has steadily grown because he captured the market's average growth without the self-inflicted wounds of emotional trading. He didn't try to outsmart the chaos. He built a system that made the chaos irrelevant. That profound sense of anxiety our generation feels comes from everyone trying to be Alex. We've been sold the lie that we need to be hyper-reactive day traders to succeed. The truth is the opposite. The real power and the peace of mind comes from building a system like Ben's. And that all begins with learning how to filter the tsunami of information coming at us, which I think is the perfect place for us to start breaking down the core insights.
Max, that distinction between being a reactive trader like Alex and a systematic investor like Ben is incredibly clear. It feels like the first step is to change our relationship with the news itself. So let's decode a real-world example to make this tangible for everyone listening. When we hear a headline like, "Tariffs on Chinese goods to increase to 30%, our instinct is to look at the stock market's immediate reaction. But how should an everyday person process that news in terms of their own wallet and their life, instead of just the red and green tickers on a screen?
That is precisely the right question to ask, Sarah. It's about shifting your focus from the abstract to the concrete. The stock market is an abstract, forward-looking machine that tries to price in future profits and emotions. Your grocery bill is concrete reality. So let's forget the stock chart for a minute and think like a business owner. Let's stick with the Nike example. Nike designs its shoes in Oregon, but they manufacture a huge number of them in countries like Vietnam and China. When a new tariff is imposed, it's essentially an import tax. The moment a container of those new sneakers lands at a port in, say, Long Beach, California, that 30% tax gets slapped on its value. Now, Nike has a choice, a very tough choice. Choice A, they can absorb that 30% cost. This means their profit margin on every single pair of shoes shrinks dramatically. Wall Street hates that, and it might hurt their stock price in the short term. Choice B, they can pass that cost, or a portion of it, directly onto the consumer. So that $120 pair of running shoes you've been eyeing now gets a new price tag of $140.
And of course, they almost always choose to pass at least some of that cost on to us.
They have to stay competitive and meet shareholder expectations. But here's the crucial part that most people miss. There's a lag. Nike has warehouses full of inventory that was imported before the new tariffs took effect. So for the first few months, you might not notice a difference. You go to the store and the prices seem the same. The headline feels like it was just noise. But then that old inventory runs out. The new, higher-cost inventory starts hitting the shelves. And suddenly, over the course of a few months, you notice your favorite shoes, your kids' clothes, the electronics you buy, they all cost a little more. This is how inflation actually enters your life. It isn't a single dramatic event. It's a slow, creeping change in the price of everything. The real impact of that tariff headline isn't the one-day drop in the S&P 500. It's the gradual erosion of your purchasing power over the next 6 to 12 months. It's the fact that your salary now buys you slightly less than it did last year. So when you see a headline like that, the intelligent question isn't, should I sell my stocks? The intelligent question is, how might this affect my budget in the next 2 quarters? And is my income growing fast enough to outpace it? It forces you to think about your own financial health, not the market's mood swings.
I love that. So the key is to train ourselves to stop asking, where is the market headed?
Exactly. And start asking a much more powerful question. How will this headline tangibly affect my spending and my earning power 6 months from now?
That mental shift is huge, moving from being a market spectator to the CEO of your own financial life. But that leads to the next big challenge, which you touched on with the reactivity trap. The sheer volume of information is a fire hose. You have inflation reports, interest rate decisions, geopolitical tensions, trade negotiations. It's relentless. When you're bombarded with all this conflicting and emotionally charged news, how does an everyday investor who isn't a full-time analyst, build a filter to stay sane and avoid getting swept up in the collective panic.
This is where you move from defense to offense in your own mind. You can't stop the fire hose of news, but you can build a system to manage its flow. The most powerful tool I know for this isn't a piece of software. It's what I call a financial constitution. It's a simple document, maybe just a few bullet points you write down on a piece of paper or in a notes app on your phone. The critical thing is that you write it in a moment of calm and clarity, not during a market crash. This document becomes your personal set of unbreakable rules, your guiding principles. It's the constitution you swear an oath to.
What would be in a typical financial constitution? What kind of rules?
They are profoundly personal, but they often include statements like, "My investment time horizon is 25 years or more. I will not make decisions based on what might happen in the next 25 days." This immediately neutralizes short-term volatility. "I will invest $500 every month on the first of the month, regardless of what the market is doing." This automates your discipline and turns you into a systematic investor like Ben. "I will not check my portfolio balance more than once a quarter." This is a huge one. It prevents you from making emotional decisions based on daily fluctuations. "A market decline of over 20% is a buying opportunity, not a catastrophe. I will stick to my plan or even consider investing more if I am able." Think of it like being an airline pilot. If a pilot flying from New York to LA hits a patch of severe turbulence over the Rockies, they don't rip up their flight plan and try to land in Denver. They trust their instruments, they trust their training, and they fly through the storm, knowing their destination hasn't changed. Your financial constitution is your instrument panel. The news is just turbulence. When a scary headline about, say, trade negotiations with Canada collapsing hits your phone, you don't ask, "Oh no, what do I do?" You simply consult your constitution. Does this news change my 25-year time horizon? No. Does it stop me from investing my $500 on the first of the month? No. Your filter does the work for you. It allows you to acknowledge the news, categorize it as interesting but not actionable for me, and move on with your day. You can't control what presidents or central bankers will do, but you have absolute 100% control over your savings rate, your investment plan, and your own behavior. That's where you should focus all your energy.
So the filter isn't about ignoring the world, it's about processing the world through your own predefined principles.
That's exactly it. It's the ultimate defense against emotional contagion. And it's built on this core truth. Your portfolio's success depends less on predicting the news and more on having a plan that makes the news irrelevant.
Okay, I'm with you completely. We've reframed our relationship with the news by focusing on our personal economy, and we've built a defensive financial constitution to protect us from emotional reactions. Now let's talk about the final step. How do we move from simply surviving this chaos to actually thriving in it? What is the concrete strategy, Max? What is the smartest move to not just preserve our wealth, but to actively grow it by using this volatility to our advantage?
The strategy is going to sound almost boring, Sarah, because it's not flashy, it's not a secret stock tip. It is, quite simply, to fully embrace the mindset of a long-term business owner instead of a short-term stock renter. Let's go back to that strange but true concept. In many ways, high-quality businesses love inflation. It sounds bizarre, but let's think it through. When the cost of everything goes up, great companies with strong brands, your Apples, your Costcos, your Nikes, have the power to raise their prices. We just discussed this. When Nike raises the price of an Air Force One from $100 to $110, their revenue for every pair sold goes up by 10%. If they can manage their own costs effectively, a large portion of that price increase flows directly down to their bottom line as profit. Now, here's the billion-dollar question. Who gets that extra profit? The employees might get a small cost of living raise, but the real beneficiary is the owner of the business. And in the public markets, the owners are the shareholders. By owning a piece of that company, you are giving yourself a claim on that future inflation-driven profit. You are on the right side of the equation. This is the single most important concept for building wealth in an inflationary world.
And that's where market chaos becomes an opportunity.
It becomes the greatest opportunity imaginable. I want everyone listening to perform a mental exercise. Imagine your favorite clothing store or your go-to tech brand announces a surprise 40% off store-wide sale for 1 week only. What do? You don't run screaming out of the store in terror. You run in with your wallet open, excited to buy the things you already wanted at a massive discount. And yet, when the market, which is simply a collection of the greatest, most profitable businesses in human history, announces a 40% off sale, we call that a bear market or a recession. What does the average person do? They run screaming for the exits. They sell everything in a panic, locking in their losses. The strategic shift is to start viewing market downturns for what they are, a sale. A temporary discount on high-quality assets. When the market is in a state of fear because of some scary headline, that is your 40% off coupon. That is the moment your financial constitution kicks in and tells you, this is the opportunity we planned for. This is the time to deploy capital to buy more shares of great companies at prices we might not see again for a decade. Every recession in history has ended. Every single one. And everyone has been followed by a new period of growth that reached even higher peaks. The fortunes of our time will be made by the people who have the discipline and the courage to be buyers when everyone else is a terrified seller.
It completely reframes a recession. It's not a catastrophe to be feared, it's a clearance event to be welcomed.
You just summarized the entire philosophy in one perfect sentence. That is the mindset that separates the wealthy from everyone else. Because you have to remember, market downturns aren't a reason to sell, they're a sale. And a recession is simply a clearance event for the patient, long-term investor.
Max, everything you've shared, the idea of a financial constitution, seeing downturns as sales, it's incredibly powerful. But I also know that this kind of wisdom is rarely learned from a textbook. It's almost always learned from scars. So I have to ask, to make this real for everyone listening who might be feeling that fear right now, was there ever a time when you personally fell into the reactivity trap? Was there a specific moment, a costly mistake, that forever changed how you approach investing?
Absolutely, Sarah. And I think it's the most important story I can share because it's the foundation for everything we've just discussed. It was 2008, the great financial crisis. I was in my mid-20s and I thought I was smart. I'd read the books, I understood the theory, and I had my portfolio set up. But theory is one thing, living through a historic market collapse is another beast entirely. Every single day, I was glued to the news. I had CNBC on in the background, a stock ticker glowing red on my computer screen. It was a constant drip, drip, drip of my net worth evaporating. I remember the headlines: Lehman Brothers collapses, AIG bailed out, global financial system on the brink. It wasn't just noise. It felt like the world was ending. That knot in your stomach that we talked about, I was living with it 24/7. My friends were losing their jobs, and the collective panic was so thick you could feel it in the air. And I watched my portfolio, my hard-earned money, go down 20%, then 30%, then close to 40%.
What was going through your mind at that 40% mark?
It was a battle. My rational brain, the Ben investor we described, was saying, this is the plan, stick to the plan, this is a long-term game. But my emotional brain, my lizard brain, was screaming, get out, save what's left, you can always get back in later when things are safer. For weeks, I fought that battle. But eventually, after another brutal down day, I hit my breaking point. I couldn't take the psychological pain anymore. I capitulated. I logged into my brokerage account, and with my heart pounding in my chest, I sold almost everything. And in that moment, Sarah, it felt like relief. It felt like I had stopped the bleeding. I told myself I was being prudent, that I was cutting my losses, and protecting my capital. I had taken action. I was back in control.
But you weren't.
I was dead wrong because I didn't cut my losses. I realized them. I turned a temporary, on-paper dip into a permanent, real-world loss of capital. And the worst part, the getting back in later part, never happens how you think it will. The market found its bottom in March of 2009, but was there an all-clear signal? A headline that said the coast is clear, it's safe to invest again? Of course not. The news was still terrible. Unemployment was still rising. It still felt risky. So I hesitated. And I watched from the sidelines as the market began the most ferocious, decade-long bull run in history. I missed the entire first leg of the recovery because I was waiting for a feeling of safety that never came. That mistake, that single act of selling out of fear, cost me more than any bad investment could ever have. It was a painful, expensive, and deeply humbling lesson. But it taught me the most important truth in finance. The biggest risk in investing isn't a market crash or a bad economy. It's the person staring back at you in the mirror during a crisis. My own emotions were, and always will be, my greatest financial enemy. And that's the day the idea of a financial constitution was born for me, not as a theory, but as a survival mechanism.
Max, thank you for sharing that. I think everyone can relate to that feeling of internal conflict. And hearing your story makes the principles we discuss so much more real. That lesson is truly timeless. So let's use that lens to look forward. You've navigated us through the chaos of the present. As you look out over the next 3 to 5 years, drawing on all the current geopolitical tensions and economic shifts, what is the one major trend you believe will define financial success for investors?
If I had to place a bet on one seismic shift, it would be the rise of what I call the Great Reconfiguration, but what the industry calls reshoring or onshoring. For the last 30 years, the global business mantra was efficiency at all costs. We built incredibly complex, lean, and globalized supply chains designed to produce things as cheaply as possible, no matter how far away. And it worked until it didn't. The pandemic and subsequent geopolitical fractures revealed that those hyper-efficient supply chains were also incredibly brittle. One broken link in one country could bring entire industries to a halt. Now the pendulum is swinging back. Boards of directors and governments are no longer just asking, what is the cheapest way to make this? They're asking, what is the most resilient way to make this? Resilience is the new watchword. This means bringing manufacturing and critical production not necessarily back to the U.S. itself, but back to North America or to trusted allied nations. It's about shortening the supply chain, making it less vulnerable to the whims of a single regime or a global crisis.
So what does that look like in terms of actual investment opportunities? Where does the money flow in that kind of world?
The downstream effects are massive. This isn't just about building a few more factories in Ohio or Mexico. Think about what's required to support this shift. Advanced manufacturing and automation. You can't compete on low-wage labor, so you have to compete with technology. This means a massive investment in robotics, 3D printing, and automated factories. Companies that build the picks and shovels for this new industrial revolution are incredibly well-positioned. Next-generation logistics. The entire network of how goods move across North America will need to be upgraded, from railways and trucking to smart warehouses and logistics software. Energy independence and the grid. You can't run a new industrial base without massive amounts of reliable energy. This will drive huge investments in everything from natural gas infrastructure to renewable energy sources and modernizing the electrical grid. This is not a one-year trend. This is a multi-decade tailwind. For a long-term investor, understanding this shift away from pure efficiency towards resilience is, I believe, one of the most significant strategic opportunities of our lifetime.
A fantastic perspective, moving from a brittle, globalized system to a resilient regional one. Max, this has been an incredibly insightful conversation. Thank you for cutting through the noise and giving us such a clear, actionable framework. To everyone listening, if you found value in today's episode, here are 3 simple things you can do right now to support the show and your own financial journey. First, share this episode with one friend or family member who you know feels overwhelmed by the financial news. It might be the conversation that changes their perspective. Second, if you haven't already, hit that subscribe button on whatever platform you're using. It's the best way to ensure you never miss these weekly breakthroughs. And finally, we'd love to hear from you. Leave a comment or a review and let us know what your biggest takeaway was from this conversation. We read every single one. Max, thanks again for your time and wisdom.
My pleasure, Sarah. It was a great conversation.
And for all of our listeners, wherever you are on your journey, thank you for tuning in. Always remember this: financial freedom is not about having a crystal ball to predict the future. It's about building a plan that makes a crystal ball unnecessary.